All right, let's talk about taxes in India. Now, I know what you're thinking. Boring, right? But what if I told you it's actually a fascinating mystery, a puzzle that affects millions of people? Today, we're going to ditch all that dense legal stuff and figure out a really simple question. Who actually has to pay tax in India and why? Let's dive in.
So let's kick things off with the big one, the question that really gets to the heart of this whole thing. Have you ever wondered, say you're working remotely for a company in the US, or maybe you're an NRI just visiting family back home? Could the money you earn outside of India still get taxed in India? I mean, is that even possible? Well, the answer might not be what you think, and stick with me, because by the end of this, you're going to know exactly how it all works.
Okay, like with any good mystery, you've got to start with the basics, right? Before we can figure out who pays, we need to be super clear on what we're even talking about. So first things first, what exactly is a tax anyway?
You know, when we pay for something, we usually expect to get something specific back. You buy a coffee, you get a coffee. Simple. But taxes, they work differently. The key idea here is no direct benefit. You're not buying a specific road or a piece of a hospital. Instead, it's a compulsory payment we all make into one big government pot. And that pot is what pays for everything we share. Roads, our military, public schools, you name it. It's all for the collective good. And this whole system has a few really important goals. First and foremost, obviously, it's about raising money for the government to run the country. But it's about more than just that. Taxes are also a tool to help balance things out, to reduce the gap between the rich and the poor. They can also be used to discourage stuff that's not so great for us, like putting high taxes on cigarettes. And on the flip side, they can encourage good things, like giving you a tax break for saving money or donating to charity. It's actually a super powerful way to steer the economy.
Okay, so our foundation is set, we know what a tax is and why we have them. Now let's bring in our two main suspects in this whole mystery, the two main types of taxes.
So here's the easiest way to think about this. A direct tax? It's like getting a bill with your name printed right on it. You see it, you know you're paying it, and the money goes straight from you to the government. But an indirect tax, well, it's a little sneakier. It's hidden, baked right into the price of something you buy. When you buy a movie ticket or a new shirt, part of that price is the tax. The shop collects it from you and then hands it over to the government. So you're still the one paying, you just don't really see it happen.
And to give you real-world examples, your income tax, the money that comes out of your paycheck every month, that's a classic direct tax. The goods and services tax, or GST, that you pay on pretty much everything, that's the big indirect tax. Now, for our mystery today, we're going to zoom in and focus specifically on that first one, income tax.
Right. Now we're getting to the real core of it. This is where the investigation gets super interesting, because we've just found the single biggest clue that's going to crack this case wide open. And it's all about something called the residence rule. Okay, and this is probably the most important thing to get straight, because it's a huge misconception. Your tax situation in India has almost nothing to do with your citizenship. Seriously, it's not about what passport you hold. It all boils down to one simple thing, your physical presence. How many days did you actually spend inside India during the financial year? That's it. That's the key. And to figure out that physical presence part, the tax law has two basic tests. It's like a little checklist. First up, the 182-day rule. Pretty simple. Were you in India for 182 days or more in the financial year? That's basically half the year. If the answer is yes, you're done. But if it's no, there's a second test. It's a two-parter. Were you in India for at least 60 days this year? And have you been here for a total of 365 days over the last 4 years? And the result is super straightforward. If you pass even one of those two tests, boom. For tax purposes, you're considered a resident of India. If you fail both of them, then you're a non-resident. It's that black and white. But wait, there's one more little twist. For everyone who qualifies as a resident, we have to dig one level deeper. The law then looks at your history over a longer period. Basically, have you been a long-term, consistent resident in India? If yes, then you're called a resident and ordinarily resident, or ROR for short. If you're a newer resident, you might be a resident but not ordinarily resident, or RNOR. Now, I know these sound like a mouthful, but trust me, you're going to want to remember these terms, because the difference between them is absolutely massive. And here we go. This is the moment we've been building up to. This is the big reveal. This is where all those clues we've gathered, resident, non-resident, ROR, and RNOR, all come together and finally solve our puzzle. So, you've gone through the checklist, you've figured out your status. Great. But what does that actually mean for your wallet, for your bank account?
How does this little label change what income you actually have to pay tax on?
Okay, this chart right here, this is basically the answer key to the entire mystery. Let's break it down. Look at those top 2 rows. Any money you earn in India or receive in India, well, that's taxable for everybody. Doesn't matter what your status is. Easy enough. But now, look at the bottom 2 rows. This is where it gets really interesting. A business you have abroad, but that you control from India? Well, RORs and RNORs have to pay tax on that, but non-residents don't. And then there's the big one, at the very bottom, all other foreign income. This is the absolute game changer. Only the ROR, the long-term resident, has to pay Indian tax on their entire global income. For everyone else, it's off the table.
Now, a chart is one thing, but let's make this really hit home with a concrete example. Let's imagine one person. They earn the exact same amount of money from the exact same sources. The only thing we're going to change is their residential status. Let's see what happens. First up, if this person is a resident and ordinarily resident, an ROR, remember, they get taxed on their global income. So everything gets pulled into the Indian tax net. Their total taxable income? A whopping 11,30,000 rupees. But now, watch this. If that exact same person with the exact same earnings is a non-resident or an NRNR, their foreign income is suddenly excluded, and their taxable income plummets to just 8,20,000 rupees. That is a massive difference of over 3 lakh rupees in taxable income. And it all comes down to just one thing: how many days they spent in the country. So there you have it. We've followed all the clues, we've seen the powerful impact it can have, and I think we can officially say, mystery solved. So let's just wrap this all up with the one key takeaway you need to remember. If you walk away with just one single thing today, please let it be this. When it comes to Indian income tax, it is not about your passport. It's not about your citizenship. It is all about your physical stay in the country. That determines your residential status, and your residential status is the master key that decides what part of your income India gets to tax. And I'll leave you with one final thought to chew on. These rules, they're designed to be fair and certain. They're based on something you can count, days spent in a country. But in today's world, with remote work and digital nomads, in a world that's becoming more and more borderless, does a system that just relies on counting days on a calendar still make the most sense? It's a really interesting question to think about, isn't it? Thanks for digging into this with me today.